Ladies and gentlemen, good day and welcome to the investor call of Cigniti Technologies Limited to discuss the Q3 and 9 months FY22 results. We have with us today from the management, Mr. Srikanth Chakhilam, Chief Executive Officer and Non-Executive Director, Mr. Krishnan Venkatachari, Chief Financial Officer, Mr. Sairam Vedam, Chief Marketing Officer, and Mr. Raghu Govidi, President and Global Delivery Head. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Snighter Albuquerque from Adfactors PR. Thank you, and over to you, sir.
Thank you so much, Stephen. Good evening, everyone. Before the call, we would like to point out that certain statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. The investor call may contain forward-looking statements based on the currently held beliefs and assumptions of the management of the company, which are expressed in good faith and, in their opinion, reasonable. Forward-looking statements include known and unknown risks, uncertainties, and other factors which may cause the actual results, financial conditions, performance, or achievements of the company or industry results to differ materially from the results, financial condition, performance, or achievements expressed or implied by such forward-looking statements. The risks and uncertainty relating to these statements include, but are not limited to, risks of expansion plans, benefits from fluctuations in our earnings, our ability to manage growth and implement strategies, competition in our business, including those factors which may affect our cost advantage, wage increase in India, our ability to attract and retain highly skilled professionals, and our ability to win new contracts, changes in technology, availability of financing, ability to successfully compete and integrate our expansion plans, liabilities, political instability, and general economic conditions affecting our industry. Unless otherwise indicated, the information contained herein is preliminary, indicative, and is based on management's information, current plans, and estimates. Thank you. And over to you, Srikanth, sir.
Good evening, everyone. Thank you for joining the Q3 Concall and earnings. Just to give you some quick highlights, the company had an uptick in its revenue in the current quarter by 4.1% in dollar terms and about 5.7 terms in INR to rupees 325.4 crores in comparison to 307.9 crores in the previous quarter. The company during this quarter has won 18 new clients, and the notable client additions include large enterprises and also 4 new Fortune 500 companies. We are on track to exceed our internal revenue targets for the year and finish the year in a good note. Our renewals and order book for the year ahead are also on track, and historically we have seen about 80-85% of our revenue renew for the next financial year, and this year also doesn't seem any different. And we continue to invest in elevating our digital positioning, and like we mentioned in the previous earnings calls, we recognize the current digital trends and the acceleration of the practical application of these trends that organizations are undertaking to their business growth. So all the services that we are offering are ultimately related and integrated. The digital complexity is continuing to grow at a rate that far outpaces any organization's ability to wrap their arms around and assure that quality and speed are needed for the bare minimum of their success. So based on this and based on the spirit of being an end-to-end digital assurance provider of choice, we have been investing into new offerings. And just to give you a quick expansion of the services that we are offering beyond quality engineering. We have been investing into enabling organizations for their DevOps journeys. And although continuous testing has been the core of our services for the last 5 years, we have spread our wings to support end-to-end DevOps transformation that includes orchestration of automation of delivery pipelines, infrastructure management, and organizing production feedback. We have invested into 5G assurance offering. Just to give you a quick potential of 5G, potential of 5G adoption is absolute, both as new phase of digital applications as well as the digital delivery backbone, both in public and private networks. Many organizations have challenges to ensure that their applications are 5G ready, and the use cases are endless. Consumer and business applications across telehealth, manufacturing, AR, VR, and gaming, IoT services, connected vehicles, just to name a few. And Cigniti is one of the first companies to roll out a 5G assurance offering that leverages a real 5G network in partnership with a company called Innovate 5G. And the services that we're offering at this point is 5G advisory and ideation, 5G quality and 5G network function assurance, 5G optimization, 5G experience assurance, and 5G security testing. We have also invested into cloud migration assurance. And irrespective of the hyperscaler, we provide fast, secure, and smooth cloud migration assurance services with certified cloud migration professionals along with our platform. And RPA, we have been investing for quite some time now, and we have seen a fair bit of traction in this place, whether be it bot development and testing services for RPA, right from conducting the technology assessment to designing and orchestrating bots. We have been strategic partners for several customers in the RPA implementation. And we've been investing and building foundations and case studies in all these areas that I mentioned. And we are going to see a good progress in the next 12 to 18 months and help create value for all the stakeholders. In this regard, we've also added new leadership into the organization. We have onboarded Mr. Vinay Rawat as our new Chief Revenue Officer, who had successful stints in the organizations he's worked for in the past. And we are confident that he will be an asset to the organization and we lead all the revenue initiatives. We've also onboarded a new Chief Officer, Sairam Vedam, who is also present on this call, and is an accomplished and a digital marketing leader with successful contributions in all the organizations he has worked for. The company has invested in additional manpower in line with business transformation initiatives and commencement of many different contracts. And the reported EBITDA for this quarter stood at 40.44 crores and the margin at 12.4%. We continue to see margins at similar levels for at least 1.52 more quarters, both on account of demand and supply issues as well as investments into growth. However, as we are able to get into more new age offerings, both in quality and digital assurance areas, we'll definitely see an uplift and easement. We are putting all efforts to move away from T&M into full-blown managed services, which gives us leverage on EBITDA and as well as reduce dependency on contractors that we've had to hire in the last few months. And attrition levels are close to 22% in this quarter as we continue to work on returnship programs, investing in training, L&D, working on alternate channels of hiring on-site, investing into nearshore facilities, and all the other initiatives that we mentioned in the previous earnings calls as well. We continue to focus on pivoting towards a digital assurance company, and we're seeing opportunities to pilot offerings and strengthen many case studies. And all these efforts should see positive results in the next 2 to 3 quarters. One last thing is we've also been recognized as a leader in continuous testing in ISG matrix, which is one of the recognitions that we got in this quarter. For other key financial updates, I will now hand it over to you, please. Hello, Christian.
Thanks for attending the call. I think it's been a great quarter in terms of both revenue growth and the EBITDA growth on a standalone. Just comparing to the last quarter, while we have moved up by 200 basis points, which is about 2% on the EBITDA, the revenue has grown by about close to 5%. What it leaves a trail basically probably is that when I'm just looking back and reflecting on what it was 32 million in the last quarter of the last year. From there where we are, I think sequentially, I think we have been growing on average at about 7-8% to run it up. And one notable point basically, which has to be noted across very clearly, is that what was the revenue which was there in the last year of 122 million. We have already covered that 122 million in 3 quarters, which means that we are going for a good galloping growth, which means that's a tremendous potential we have in terms of our strategies, what is working through. First, I'll cover up few of the metrics probably, and then get through in terms of the dissecting of the profitability and the questions around that, what could be lingering in the mind, and then I can take up the forum in terms of after the other speakers finish in terms of the question and answer session. So we have done about 43.86 million for the quarter, which is by far the best, and we are poised for a good growth, and with a healthy order book position, we are in a commendable situation in terms of where we are to head basically. The EBITDA for the 9 months, EBITDA for the quarter stood at about 12.4%, and the normalized EBITDA, if it had not been the SEIS reversal, for us would have been at about 13.5%, which means about close to about 1.1% has been affected by the SEIS reversal, which are relevant to the laws which has been passed out, and we have no other options on that, just to provide it as per the accounting norms. Our top 20 continue to contribute about close to 46%. We have serviced about 235 accounts, out of which 10% of the accounts, about close to 8%, to be very precise, roughly about 21 accounts are about $1 million account plus. And our dollar rates in terms of realization on-site remains more or less same at about $74, and the offshore has marginally improved by about 50 cents to about $21. And the on-site offshore mix remains at about 22 and 78% in terms of the resource, and the revenue mix is about on-site at about 51 and 49 for offshore. While the endeavor has been to really, in terms of sector basically, if you look through my BFSI sector is at about close to 20%, and travel and hospitality, we have started bouncing back, and we are in a good wicket, and we are hopefully confident that we should be able to gain much more traction on the sectoral contribution. If you look at a couple of things on the cash flow front, probably we've generated in the 9 months about close to 38 crores net cash from operations, and on a comparable basis, probably this may reduce, but I think I have the reasons counted upon, and we have not dwelled into debt or anything, but we are confident to really generate more amount of cash as it starts moving up. Just a comparison in terms of the profitability, while we did very clearly about 15.9% in terms of the EBITDA last year, but I think last year is an exception year basically, and I want you all to take a step back and look at the pandemic, what it has affected clearly. And if I have to normalize the last year, that will come down by about a percentage basically, because the travel and other costs were reduced and the salaries were cut down by about 5%. With all that being there, basically, we were our normalized EBITDA would have been there at about net note like the previous year at about 15%. On a comparing to that, where we are at about 11.5% for the whole year, where it is for the 9 months where we are, the net contribution is on account of SEIS would have swept up by at about 1%, and then another 1.5% is 1.5 to 2% was necessitated by way of revision in salaries during the mid-year post the increments which were given at an average at about 12%. This was something to the surprise because while people will definitely ask the question that why these things were not anticipated and estimated, yes, we never anticipated that the second wave and third wave could run deep into the system, which really has put a pressure in terms of us, invariably, not only us, across the globe, basically, in terms of the immigration laws, and the available pool was very little, and we had to latch on to the pool, so which means that comes at a higher cost, invariably. And the commitments given to the clients as in our embarking journey to move to a 500 million journey in 4 years, testing, beyond testing, around testing, and then getting into the digital and other flavors. So whatever has been invested and campaigned out very clearly. So when we have put a foundation for laying the growth, we don't want to go back on the words clearly, and that is one of the reasons probably we need to retain these people by additionally paying, and we have to latch on to the contractors to really see that what best resources can come into the market. I think this sucked some amount of the margins into the business. But I think the good side or the good part is that the last 3 years, when you look at it from 2017 to 2020, the average annual growth rate for the company has been at about 7 to 8%. The 2021 as a year, basically, we were able to just put our hands out on the flood and say that, look, we have survived that because of the sectoral focuses which we did. But I think that is what is the year which made us start and then invest in people, investment in R&D, invest in various portions. And the pleasing part is that in our journey of 500 million, what we anticipated a growth of about 30%, 33%, which is there for the year in terms of both organic and inorganic, which include inorganic 20 million. We have evaluated all the proposals. While it is pleasing basically that we have not given a cash outflow of say about 2 times the revenue, 3 times the revenue to really go ahead and acquire companies, but I think we have also fired the cylinder on the organic growth, which has really set up the motion basically for a high double-digit growth in terms of the way we have delivered out now in terms of covering up the last year revenue in 9 months and then still poising to move ahead on a very positive note. So that leaves us a clear mind is that I have invested and sacrificed my margin about 1.5% on a net neutral basis, but these assets lie with me in terms of either the IPs or the processes or the people, and this is visible in the order book and the revenue growth rate, what I'm trying to do. So that is one of the satisfying points for us, and we are very confident. As Srikanth said, that we expect this labor turnover issues, and we expect these immigrations have started opening up from March 1st further. We expect all this to get settled down in this quarter, and then the mid of next quarter, the reflexes should start feeling in the numbers across the globe invariably, and the crazy madness at which people have been running around the companies in terms of trying to gobble the resources will come down and stabilize, and the clients have started realizing in terms of their need to revise these rates, which we are seeing a very positive trend in terms of absorbing some amount of cost by the clients very clearly. With all these initiatives and a few other initiatives which my colleagues will cover, I think we are pretty confident that we'll be able to pep up the margin as we start moving up a couple of quarters down the line as a progressive process. I think with this forum, probably now I leave the forum open and I put it across to my. Also, just one last point which I want to take is that the PAT today, what stands there basically is after a full-blown taxation as what we have been, and we are no more in any concession era, and that is one of the points to be noted comparing to partial concessions which we received in the last year, and that is also one of the reasons if you look at it on a net on PAT basis. With these few words, probably I will pass on the mic to my colleague Sairam Vedam, who is the Chief Marketing Officer, and who will really talk us through in brief about the digital journey. Sairam, over to you.
All of you once again to the earnings call update. I'm pretty excited and positive representing all of our Cigniti management team here. I would spend few minutes taking 4 pieces of update or commentary that I want to give. The market insights and trends, though most of you might be following, is very interesting to note. The IT spending itself is projected to go up to 4.5 trillion in 2022, about 5.5%, but more, and the previous year according to Gartner. But what is important to note there is a lot of enterprises this year are expected to build new technologies and software rather than buy off the shelf. What it means is if they're starting to build, needless to say, they need to be assured and that needs to be continuously done. And a bunch of the technologies are all digital centric, is what Gartner says, which throws open an infinite amount of opportunities for companies like Cigniti. IDC interestingly says by 2026, every successful enterprise that generates digital innovation will derive 25% of revenue from digital products, services, and experiences, which is a clear-cut validation that any global company today, which are our customers, they got to be digital first to stay ahead. I repeat, they got to be digital first, which means that throws opportunity window for Cigniti, which has the ability to ensure digital first experiences are enabled to our customers through digital assurance and engineering. So that's from the market insight. On the buyer preferences, if you look at customers today, I'm sure Raghu will also validate this. Customers are embracing journeys to become digital first, and no vertical segment is exception to this. Be it banking, financial services, be it Industry 4.0, smart manufacturing, health tech, even travel and transportation. In fact, they need more innovation than ever. And digital thus becomes a dialogue as a confluence between cross-sectional CXOs in the customers we talk to, which means that they own digital outcomes and extended digital dialogues, which means a digital assurance provider like us have a larger seat at the table, because those companies, as Mark Andreessen said, software is eating the world. They are racing to achieve market leadership through providing impeccable digital experiences through end-user-centric digital models, and that can only happen by digital assurance. Hence, I want to establish the fact that digital assurance is extremely important for global companies' digital transformations program success. In fact, it becomes the bedrock for companies to become digital first, and that establishes the fact that Cigniti is today in a unique position to leverage its deep-rooted expertise of helping those companies, 200 plus customers that we serve, accelerate the digital transformation initiatives through world-class digital assurance and digital engineering. So that's from the market commentary standpoint. I'll take a few minutes to do some updates on where we are and what we are doing, and Raghu will go deeper into that as required. Our digital assurance today can be broken into what we call cloud IoT, 5G, AI-led customer experience, including omni-channel, and as well as robotic process automation. So that's a full bouquet of digital assurance offerings. And to strengthen that, we are, in fact, very excited to unveil few updates to you. We have a hyper-intelligent automation focus, and we built a platform called Insta, which is a scriptless, self-healing, autonomous, AI-driven, low-code scriptless test automation platform that can drive in about, one of our customers reported 44% of reduced test execution time with 75% more automation coverage. That ties back to what Srikanth was telling, our RPA and hyper-intelligent practice, which under the stewardship of Raghu is growing leaps and bounds with partnerships with global leaders like UiPath, Blue Prism, and LeapWorks. Number one. Continuous engineering. At breathtaking speeds, the software getting developed, it's a no-brainer. Agile and DevOps are de facto standards, even DevSecOps. But what we are also seeing is, extending the wings to areas like full stack observability, site reliability engineering, and what I call the world of adjacency in ops and post-production optimization. Areas around AI ops, model ops, and data ops will be the ones that we will be looking into. And towards that, today we have what we launched, a 360-degree digital customer experience monitoring platform. It's AI-driven. It's sentiment analysis inbuilt, and it monitors customer journeys, and we call it Insight, rightfully so, which also helps a confluence of customer experience leaders and product leaders in end customer organizations, which means that today it would not only predict a network and device performance, but it would also capture the entire sentiment of customer, and that throws the entropy that otherwise would be there in ensuring frictionless customer experiences. And with an intuitive predictive dashboards that have been built, those metrics could help us monitor the health of the application with multivarious parameters. And the fourth dimension is the most exciting. The connected experience is what I call through 5G assurance and IoT. The Innovate 5G, which is a very unique first-of-the-sort partnership that Srikanth outlined, helps us do path-breaking work in terms of providing 5G assurance capabilities. See, look, all of us understand, right? Video is going to drive unbelievable opportunities. We are talking about the age of metaverse, but for which the infrastructure has to be at a different zone where digital health, 3D conversational experiences, smart automotive, and a whole bunch of sensory data that gets exchanged. And 5G is going to revolutionize the way we consume, we interact. And that's where we've already put in our foot, and very strongly. Lastly, we would also be looking at extended adjacency areas of digital engineering. But for today's call, I think I want to emphasize that digital assurance is the bedrock of customers becoming digital first. And that makes me humbly submit it to Raghu, who's actually driving all this with our focused delivery leadership and teams. Raghu, over to you.
Tom, I think just to take a cue from where you have left the conversation, I think all of us on the call know that with this whole pandemic that has set in over the last 18 to 24 months, if not anything, the least and the most impact both has been on acceleration of digital journeys across enterprises, across industries, across countries, right? So everybody wants to see how they can use the opportunity to optimize, make better whatever they have as legacy products and legacy services. At the same time, welcome new technologies, welcome new services, welcome new products into their mix, so that at the end of the day, the customer experience to the end consumer is world class. I think that change is what we have seen across the world. Now, in line with that, Cigniti, of course, conventionally we were a quality engineering company, and what we did as part of this whole journey is we brought in the digital mix into the landscape, and looking at the whole overall digital transformation that our clients are undergoing, we have started offering digital assurances and digital engineering services, both, right? Now, I will give you a little bit of feedback as to how we are seeing it on the floor on a day-to-day basis. Across all our clients' landscape, when we went and looked at what they were doing in their digital transformation journeys, and of course, different clients will be in different points in that digital transformation journey, we went and expanded our offerings to ensure that we are able to help deliver value beyond just testing. So Sairam spoke about RPA. For example, we did a lot of work in RPA over the last few quarters that as a company which is strong in testing, in domain, in automation, there's no reason why we can't offer that service to our clients. So that resonated with our clients well. We are helping our clients do a lot of automation in their business processes end to end, and therefore won several deals in RPA and served value there. Similarly, a lot of clients who were stuck with legacy automation technologies and solutions which were expensive, which were not agile for the needed digital acceleration, we went and delivered a low-code, no-code AI-enabled platform, which is called Insta, which speeds up the way clients can do automation, and therefore also takes away the pain of having very high-end talent in the automation space. 5G, all of us know, is the next wave that has started coming. In fact, you already see some articles out in the industry where 5G is, if not tested well, has already started causing problems. So again, we partnered with Innovate 5G, as Srikanth said, and as a digital assurance company, we are giving solutions to our clients to ensure that their applications that they are developing are ready for consumption in a 5G world. All these offerings that we have invested in over the last few quarters, built and resonated with our existing clients, have started producing results. And not only with our existing clients, with all the new prospects that are coming into the company, we are able to now talk about not only a digital assurance story, which is stacked up on the quality engineering story that we had in the past, but also we are able to now broaden our offerings and offer digital engineering as service line as well. This is helping us, of course, expand the value in terms of what we deliver to our clients on a day-to-day basis. Coming back to the general statement that Krishnan made earlier in the call, the skill, talent, of course, went through a lot of pressure in generally in the industry. I mean, most of us wouldn't have seen talent shortage being a problem when pandemic set in. Most of us would have thought talent will be in abundance, projects will come down, but exactly the reverse happened, right? So talent shortage, skill shortage is very much a reality. But we are also seeing signs of talent being taken in pockets for these technologies going forward in a much more premium manner, and more and more people getting trained on digital technologies will ease away the talent pressure in the coming quarters, at least from an industry standpoint. So that's broadly the update from my sense in terms of what we are seeing on the landscape and our offerings. Back to you, Krishnan.
Yeah, we'll now open the forum for question answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ridesh Gandhi from Discovery Capital. Please go ahead.
Hi, sir. Just had a couple of questions. The first thing, obviously, given the overall tailwind that COVID has caused for the IT industry as a whole, and we are seeing companies on a high base growing actually reasonably quickly. Just wanted to understand, given our low base, given our expansion into services, given all the hiring which we have done, what is the reason for this low revenue growth?
Okay, Srikanth, I'll just take this question. Probably you can supplement it. Mr. Ritesh, thanks for the question. If you look at it, probably going by the current state of run rate in terms of the numbers where we are, I think the growth is in the order of 32%, 33% for that comparing to the last year, what is coming through. Just going by the numbers I'm calculating. And I strongly feel that this is a great growth phenomenally. So the lower growth normally in terms of the Q2 to Q3, always the tendency has been, if you look at the company's history, and in overall generally the industry is that October, November, December is the quarter which is subdued quarter. 1, on account of the budgets coming down. 2, on account of various holidays, be it Thanksgiving, Christmas, or the vagaries of the monsoons or whatever it is. So comparing to that, still we have broken away the tradition and we have done a growth at about 5% sequentially in terms of what it is on an absolute quarter. But I think if you look at it overall for the year, I think I just made the statement that we have moved away in terms of comparing to what it is. And if you typically compare to the last 9 months of the previous year to here, now we are doing at about 35% growth we have done already. So I'm not able to really look at it in terms of the low growth, probably.
I'm talking about in lieu of this sort of guidance which you had sort of provided, sort of indicated that the growth numbers and that the profit margins also would have been reasonably higher than the actual numbers we ended up seeing.
We have always been commenting to be a high growth. I think we have exceeded the expectations in terms of the high growth, what we have commented about very clearly. If you look at overall, the last 4 years, the average growth has been at about close to 7%. This year, I think we have moved away from the path and we are growing at about 35%, which is a substantial effort, considering the deep-rooted pandemic, which is again not an excuse, but I think it is a fact which is embedded, and it took some more time than what we anticipated for the people to really come through. And also the growing fact is that if you look at it, we would have definitely grown in high teens is what I remember to be a commenting, but I think we have now moved up in terms of comparison of 9 months to 9 months at about 35%, and the run rate shows very clearly that we are running it in a very systematic way to be at that top of the position. I think as against touching something on inorganic and getting it integrated or whatever it is, which is not a taboo, which will definitely be the board's purview as and when some amount of good this thing comes. But I think we have far than exceeded in terms of the growth, I would say very clearly. And I agreed on the margins basically because I reinvested back into the company that what anticipated margins really swayed on account of couple of factors which were beyond my control in terms of, and we will be more be able to be cautious and predictive in terms of trying to price in such uncertainties as we move forward. But otherwise, I would say that we are on a sound wicket in terms of growth, and our journey on the 500 billion, both organic and inorganic put together on that, achieving the first year target in terms of organic itself is a phenomenal exercise what we have done, which lays a foundation for us that our organic is going to far exceed very clearly. While we are not against inorganic, but that's the board's prerogative to look at it in terms of as and when the right opportunity comes in as we realize them. Yeah.
Got it. Sir, and just to understand, just looking at your investor presentation, the free cash flow conversion has been reasonably low for the first 9 months. Just wanted to understand, do we expect this to even out because we expect collections to happen in Q4, or how should we be thinking about that?
Oh, yeah, it's a good question. Absolutely. The free cash flow conversion has been deliberately is low this year. As a whole year, if you look at it clearly, is that while the receivable numbers per se stands at about 59 days, the DSO, which is more or less quite reasonable, but I think any higher, the main cost which moves out for the company or any kind of a service industry is the manpower cost, which is paid in 30 days, which is not Greek and Latin for any of us clearly. So the tax outflow and because what happens is that December year and March year with the tax outflow and the enhanced capex which went on account of the investments which we need to make in a few of the servers clearly. These are the one of the reasons basically, but I think in terms of the salaries moving out, and we are trying to improve this collection by a couple of days. We wanted to bring it back to 52, 53 days average. That should improve my cash collections out basically, and we are optimistic that this will improve and moving forward.
Sir, and the 130 crores of the capex, which was sorry, I take that back. So, and just to understand on the EBITDA margin front, effectively, you guys had indicated that you all were, moving to a more outcome-based approach, which is why the last quarter effectively EBITDA was slightly lower, and we'd expect some amount of the catch-up to happen like now as the outcomes are actually being delivered, etc., etc. Just want to understand, if you could sort of highlight to us what the reasons for the EBITDA being slightly lower than expectation was in terms of the margins.
Yeah. There are two ways to look at it, sir. It's a good question. We have been constantly trying to advocate the principle of outcome-based business on the newer contracts. My Q1 was low because my outcome-based business, which I won during the last quarter of the month, which was in the previous year, could not be billed or anticipated in time basically due to client's delay, and then we need to really retain out based on the relationship for about 2 months, which really dented us, and then that bounced back in the next couple of quarters basically. But my advocacy principle in terms of outcome-based business still continues, but I think it is a journey and I can't have 100% coming through on the day one because we still have time and material-based business. But what is interesting, or the interesting fact to look at very clearly in terms of the time and material business basically is that while the traditional businesses had very clearly that we had to have a named resources, today we have about close to 65% of the businesses which doesn't have named resources, which has been replaced out clearly by this delivery team, and I'm talking in front of the delivery leader who is heading the sales, which is a creditable achievement, and which gives us now the continuous scope, which now trying to look at it in terms of because replacing with low-cost resources, pressures, inducting so many people into the system so that we can really improvise on the margin and then adjust the pyramid mix accordingly. While outcome-based business is what we are trying to pitch in as we start moving up. If you look at it, for example, I talked about 21 accounts having about $1 million plus accounts, out of which almost now we are having about 16 accounts as a completely outcome-based business. I think it's a creditable achievement in terms of how we started, where we were, and how we pitched in and started moving out in terms of outcome-based business, in terms of where we are standing. So this is a continuous effort. It will happen, but if you look at it as 100% that whether it will happen on the day one, no, it is a time-taking process, and we are trying to do that, and we are at the same time trying to weed out the clients which are really getting into the nature basically as a named resource or whatever it is. So we are very optimistic and confident. The margins, again, I'm trying to make it a point very clearly that while we did the pandemic exercise when our travel was at about 32%, today my travel is contributing 16%. My order book position fell to 80 million and I pulled it up to 123 million to float around in 2021 to really achieve the revenue. And on account of cost reduction, no travel, no customer expenses, no marketing expenses, and reduction in salaries where the entire employees agree for a 5% cut across the globe. That has contributed in sustaining the EBITDA and other margins. While we are optimistic that we will reverse that, we will give an increment with enhanced growth because the commitments what we made in the business has to be done basically for our reasons of survival for the future, because if we had continued in the pandemic with same on travel, same focus on few of the sectors, which would have really made me perish. So I laid a foundation, one on two fronts. One, getting into a newer area like healthcare or whatever it is where the offerings have to roll out. Two, in terms of really looking at testing, beyond testing, and trying to take the journey towards development. When I do these two, invariably, I also thought that I'll jumpstart and do an inorganic growth for about 20 million to really pick it up and make my revenue for a 30-35% growth. However, while that didn't happen, this cylinder definitely fired and we started using the tailwind, as you rightly said, and lay a foundation to showcase our digital and transformation capabilities and our offering capabilities, for which I need to sacrifice an EBITDA margin of another 1.5% to really move forward. Which will pay out for me in the coming quarters as I start moving up, definitely. And after all, optimism is what is life, and I'm very clear and optimistic about it. Yes, we did say that we will definitely end up and we'll be able to do that with all these other calculations, but I think it swayed a bit depending on the business and global economic conditions which went away. And we are conscious of the fact we are really working out to see that in all fronts, to see that how we are going to really pepper out.
Right. So, and any use of the free cash flow then, if like acquisitions aren't going to be done, are we looking at then like buyback or in a larger part? Is it dividend or then like return capital to the investors?
Yeah, it's a great question, and the board has been continuously deliberating basically. As it stands, basically there are a lot of proposals which run through and will come out uniformly to the exchanges. The board is actively looking at all the propositions clearly, but I won't be able to give a forward-looking statement, but invariably the board is going to come back quickly and the management is representing its best in terms of the utilization for the cash flow. We will come back uniformly to the exchange as well. We take care.
Okay. So I'll just rejoin the queue. I had some more questions. I'll join the queue.
Sure.
Thank you. The next question is from the line of Danesh Mistry from Investor First Advisors. Please go ahead.
Hello, sir. Thank you for taking out the time to talk to us. Can you hear me?
Yes, sir. Please go ahead, sir. Good evening.
So good evening. So I basically just one observation from the result. If I were to see generally the incremental revenue that we have had this quarter on quarter is about 17 crores, but the employee cost has gone up by about 12 crores. So just to understand, sir, one is, and our utilization rate is also 80 or 85% plus. So just to understand, sir, over here is that you've touched upon the fact that you have hired sales and marketing talent. So does that mean that the cost is in, but the productivity is yet to come, or have we hired employees who are yet to be made billable, or is there that, or are we looking at a situation where we have to go back to customers and ask for price increases, sir?
Your third point is absolutely valid. To put it in a nutshell very clearly, we have got about 11% of the revenues, which has been a new revenue during the quarter. 11% of the revenue has come out with a gross margin of about 25%. I'm just disclosing these numbers in black and white clearly. For partial reasons, basically, is that all of this have come around testing and beyond testing together. And there was a compulsion for me to really, because of the commitments given, so the resource scarcity has to be addressed out in terms of trying to get the right kind of resources, be it from a third party, be it from our own resources or whatever it is. Coupled with that, basically, there was a big exodus where, if you see, one of the heartening facts basically is we have been able to get down from 28% of attrition to about 22-23% as it stands this day, is that on account of a midterm revisions which we were able to do for selective set of people, which was necessitated, which we know basically it has struck the margin. but we will be able to do the corrections because on the parallel, two exercises are happening, which is on a war footing basis, is that converting the contract resources into our own resource, converting the what you call high paid resources, which is our own employees, into a longer yielding margin as we remove them from the named resources. The third point is that we have already gone back and for rate revisions in January. Fortunately, we have been very successful in getting in major of the customers wherever we have gone. So we should be able to get that evened out. Your question is valid and absolutely right, and we have all these sliced up answers out very clearly that we have these numbers and we have been monitoring it constantly, and we are addressing it one by one on a parallel basis.
Got it, sir. That's very helpful, sir. Very heartening. And sir, one thing just to understand, sir, now this margin level that we have seen, so can we assume that this is the lower levels of the margin, and from here only we will see productivity gains along with the pricing initiatives that you have taken bear fruit, sir?
Absolutely. I just want you all to take it up to a slide to see very clearly that we have Q1, Q2, Q3 as a comparison. If you look at it, basically, we moved from 9.2, 9.1 to 10.4. From there, we have jumped to 12.4. So I don't see any reason for it to go below. So probably the inflex curve has come, probably the inverted parabolic curve, and we are on a growth pace. While the salary costs have gone up on a bell-shaped curve, that hit me a margin into an inverted parabolic curve, and I'm very sure that now this is going to really even out at some inflex and start moving up. So.
Oh, got it, sir. And sir, just one last point, just to understand how it is, because you are far closer to this than what we can ever be. But sir, do you think that now everybody, so this price hike is across the salary hike is across the industry. Do you think this will continue, or do you think that now it's in the base price? I mean, it's in the base numbers of your financials, and therefore next year onwards, we will not see this kind of wage inflation, sir?
There are two ways to answer it. It's a beautiful question very clearly. One, if you look at it as a global phenomena, basically, I will have a support from the economy coming through, basically, is that there is not going to be any more restrictions in the visa and other regimes which is coming through, because now today it is Corona, tomorrow Omicron, something else probably. People are now used to. People have really sat at home for 2 years and now they are used to. So that is one of the reasons that every country is opening up and the visa regimes are restricted. Once this happens, basically, and a little bit tailwind comes down, basically, we expect that resource tapering to happen, and there will be availability of resources, and people have to resort to cost cutting in terms of rationalizing the resources clearly. So this means clearly that the resource crunch, one, by way of the economic activity, two, by way of tailwind activity coming down, will definitely taper down, and we expect by about what is happening around in this quarter should be felt at mid of next quarter probably, and moving forward of mid of next quarter, which is, I'm talking about Q1 of the next year onwards, things should be good. Coming back to the prices very clearly, I think it is a norm only in India, not across the globe, but I think this pandemic taught every company basically, because the sales and marketing folks became a very vital link, and while they generate revenue on an indirect basis, in terms of billability directly, they don't really go ahead and bill to the customer. So we had to revise that, and in our company, we have done that after 3 years in terms of sales and marketing. So I don't see a job bulk of this company with respect to Cigniti. Clearly, I expect at least 40% of the folks will not go through a revision, whether the rest of the people at a low base will go for a revision. So this will not be a cause for concern for me, basically, but that should really pep up the business for me to leave more cash flow out.
Got it, sir. Understood, sir. Thank you very much, sir. Thank you, sir.
Yeah.
Thank you. The next question is from the line of Nirmal Shah from Seraphic Management. Please go ahead.
Yeah, good evening, sir. Sir, my question is with respect to the trajectory of your margins. If I recollect your Q2 call and probably post that there was one more investor call which was done somewhere in November, the impression what you all gave was that this is the lowest margins, and from there the margin improve on. Now, if I look at a Q2 margins without a ACI's reversal, you actually hit 13.5% as per your presentation, and on QOQ actually it has dipped. Now, my question to you is, sir, whatever areas what you have spoken about, the travel was constrained because of COVID, the attrition, those things were going on for a while. It is nothing that has happened in just one quarter. So what gave you that comfort that point of time to give us an indication that this is the worst of the margins and from here on it will improve? And on the contrary, actually it has come down. And similarly, you are guiding right now again that this is the lowest ever margins. From here on, it will further improve. So can you just give me the chronology of events, like what has changed in last 1.5 months? Otherwise, you would have also given that guidance in Q2 as well.
Yeah. Thank you. Nirmal Shah. I just wanted to take a step back in terms of trying to give a few of the numbers. Of course, you have the calculations with you. Is that we did an EBITDA margin of about 10.4% in the last quarter, which moved to 12.4%. If I neutralize the last quarter number itself, it would have been at about close to 11.4%, and we have improved it about by a percentage point or so. There are two factors to look through clearly. Is that there is some if you look at is that there's some amount of settlement. We had one of the senior members who joined, and we quickly spotted out, and then we agreed upon that in terms of the contract certain deliverables which has not been met, basically, that we need to part ways. While we parted ways, basically, that is one of the provisions. We never expected that parting of ways clearly, and that provisioning of the cost, which really also dented the margin percentage a little bit marginally. Two, the second reason, one second, let me put it out. Let me complete, sir. And the second portion basically is that while it is so, we had to go ahead and commit in terms of certain marketing spends, in terms of engaging the customers out very clearly on account of two exits of senior folks from the company, which was not anticipated out very clearly, and two senior folks who have been handling the sales. We need to definitely go ahead and put extra dollars of marketing dollars really to see that how best we can create an image, and not creating image, not to dent our image, and then straight away go ahead and engage with the customers and see that our order book position swells out very clearly, because that was the renewal time in terms of October, November and December. That is the second reason. The third reason basically in terms of when we started the need for the market or whatever it is in terms of the deliverables, the cost of people went up variably, and we wanted to stop the exodus of the people either following the leaders or either following the market to move ahead, and we need to make them appraisals as of 15th November, which we need to do probably effective at that date, which also definitely was not planned for or calculated for. While I can take an offline call with you in terms of talking and giving you a breakup in terms of each and every category of that numbers, and I'm sure you'll be able to appreciate me in terms of these things, events were not anticipated and we just came up on the cuff. Probably it leaves a food for thought on the table for us that these kind of contingencies as well needs to be priced in the business in terms of moving forward by increasing my contingency percentage, which I agree honestly that we will be doing it in the next year budget as we start moving on.
Sure, sir. Thanks a lot for that. And sir, my second question was with respect to the promoter's pledge of shares. Can you just give us a clarity? What was the reason for creating a fresh pledge, and what is your in future, do we expect any more things to happen like that?
Srikanth, can I take the question or you would like to take it up?
You can take, I can supplement.
Yeah. Sir, I just wanted to clarify things very clearly is that these pledges have been executed during the quarter basically by the recipient in terms of for various personal and other reasons which has been borrowed on a borrowed capital, personally what they have done. And we expect that we don't expect any more additions on behalf of the promoter. I'm talking is that we don't expect any more addition of pledging, but and we expect this to get smoothened out or evened out as it starts moving up, as they get their own cash flows generated out. I think they will be really getting it out. But these are something did about a couple of quarters back or whatever it is in terms of the borrowers where the understanding happened, but I think this was executed during the quarter invariably, which was necessitated in terms of securing the debt on various counts or whatever it is. And they are consciously aware of in terms of what is the pledge and what is the quantity and what it signifies, and they are trying to get the cash flow eased out and see that how best that can be released out. Yeah.
Okay. Thanks a lot, sir.
Thank you.
Thank you. The next question is from the line of Sudhir Peda from Right Time Consultancy. Please go ahead.
Good afternoon, sir. And I was listening to your very, very lengthy commentary about the prospects and opportunities and how companies, diverting to digital and all. So, as a layman or as a investor who don't know about the tech So just wanted to understand, sir, how it will result in the expansion of margin. Just I want to understand that simply for the FY23.
Okay. Sir, I think if I'm missing out on technical part, probably my colleagues will cover, but then return, just purely on the return basis, basically, if you look at it clearly, is that I think today's initiative in terms of the digital and transformation initiative, what we are trying to do probably is that, Raghu, you can supplement me, we are doing about close to 37% of the total revenue in terms of where we are today. We are trying to up this percentage up, and these generally comes at a higher rates in terms of realization, and the margins are slightly higher in terms of this. So definitely this will contribute, but I think we will come, since we are not in the process of giving guidance, the optimism with which we will be able to bounce back when we talk about it is that we are trying to accelerate this journey in the growth journey. If you look through what we have done comparing to 9 months to last year to 9 months this year in terms of a growth, we are trying to accelerate this growth with the newer technologies and in and around the testing and transformation initiative. So with at least 1/3 of the business contributing and slightly more coming through from this area with higher yielding revenues. That is the classic example is that if you look at it, why digital companies today are attracted at a better premium. If you look at it, they are valued at about 15 times EBITDA or 18 times EBITDA, or probably in terms of the revenue, slightly much larger X. Clearly, that shows this volume clearly in terms of the scarcity of the digital service offering companies.
But sir, their margins are way ahead of ours. So just wanted to understand how we can reach to those kind of margins.
We will, sir.
Compare with the other digital players.
Correct, sir. We have hired a CMO who is a digital expert and who just joined in us and then jumped into this call a couple of days before he joined, and then he has already jumped into the call. We have made baby steps in terms of really trying to put the piece together, and now we are going with a full-blown proposition to accelerate the digital journey. And we'll have to demonstrate it for you in terms of the margins as we start contributing to more, because in general today I can make only a theoretical statement that the rates are high, the availability and the margins are where clients are willing to pay. So definitely it is a margin accretive initiative, and that is a bet which we are taking in terms of investing on people and investing on technology and investing on customer facing trends in terms of the expenditure. So definitely we are confident that it will pay out for us. But I think if you ask me that, okay, next quarter is going to pay out, I don't think I'll be able to comment clearly on that basically, because I am making steps. I know that it will yield. I know as the revenues have yielded, the margins will start yielding, because I'm trying to get through into the engine in terms of trying to fire that out. So I'm optimistic, and with full optimism, I'm getting into the business.
So in the next, say, not next quarter or say next year, what kind of aspiration margin we are looking for next year, say two years down the line?
Sir, if you look at, again, I'm telling you, we are not giving any forward-looking statement. We want to be in the industry standards. Let's talk about, say, 3 years of my business from here. In my 4-year journey, where I have to go to about 450 to 500 million, I finished about a year. In my 3-year journey, where I have to be, I wanted to be in par with the industry standards, which will, that is the comment I would like to leave on the table, and you all know the industry standard. And we are trying to put our efforts to be there at that point of time, with about 35% of the business coming from the development initiative and 65% coming from the digital and transformation and testing initiatives. Why not? Why we cannot achieve? So the think tank team is already on the job in terms of saying that how best we can reach out there. So that is the optimism we have. We are working on all the steps, and we should be able to really get there. And there is no Greek and Latin in that, and we should be able to do a tight leash walk and get over there.
Thank you. The next question is from the line of Rajesh Kawadiki from Raj Securities. Please go ahead.
Hello, sir. I had a question on the order book. If at all you can give us some guidance around order book for the next 6 to 12 months, that would be great.
Yeah, sure. Absolutely. The order book, absolutely. As it stands, as of the board meeting I have as of today, probably just 2 days, doesn't matter much, basically, is that I'm sitting on a tight order book portion, including renewals, roughly at about close to 142 million. And I have about a month more in terms of 2 months more, basically, where a few more renewals will trickle in clearly. And I should be able to have a very comfortable position of adding another good amount of $1 million in terms of getting upping the order book clearly. As it stands, it's about 142 million. For executable for the year April 22 to March 23. While the internal order book will be something different, but what is relevant is April to March 22. Yeah.
Sure, thanks, sir.
Thank you. The next question is a follow-up from the line of Videsh Gandhi from Discovery Capital. Please go ahead.
Hi, sir. Sir, the other question I have for you is, we've been seeing a lot of the promoter actually pledging, etc. Just wanted to understand the reasons behind the pledging.
Oh, yeah. I just explained to another gentleman, and I will repeat it, sir. Basically, I think these were for their personal borrowings, which has been done at the earlier years, basically, and to secure that because of the growing complexities of the market, probably for securitization purposes, which was done recently. As their cash flows get eased out clearly, I think I'm talking on behalf of the promoters because I have raised the investors' concern, and they really shared out very clearly that as the cash flow is getting eased out over a period of time, they should be getting this out. And we are confident, and they have assured that there is not going to be any more pledge on this front, clearly.
Good. Understood. Sir, and the other question was, just to understand, strategically speaking, I think what we were looking at a few quarters ago was to expand outside of only testing into services, looking at some acquisitions. We had hired the person from ATL to sort of drive the revenues, etc. Is that sort of broadly still in line? Is there some tweaking happening to the strategy? How should we be thinking about this going forward?
So the strategy remains intact. Probably, Srikanth, you would like to, you and Raghu would like to take questions on the testing around in and around, but I think the strategy remains intact.
Yeah, strategy remains, like Krishnan mentioned, the strategy remains the same. So we are focusing on areas adjacent to testing. So traditionally, we've been focusing on test automation. It's a large chunk of our revenue. So we expanded to hyper automation, RPA, and things like that. Then, in terms of our positioning, also we are moving from quality assurance to digital assurance. We are trying to see if we can assure the digital experiences of all the clients that we have. So our strategy document and strategy Bible that we have, we are sticking to it. Now, in the last 18 months, we have evaluated several opportunities to see if we can accelerate our positioning in terms of small tuck-ins, but valuations seemed overblown. So that is still in consideration. However, we just want to be careful about what we want to pay and evaluating a build versus buy. We're continuing to build. That is not stopping. And we're looking for opportunities that can accelerate us to enhance our offerings.
Yeah. Also, Ritesh, I think my colleague addressed a few things in terms of the beginning of the call, Mr. Raghu, in terms of the delivery commitment that as to what's happening on the R&D and how the in and around of the testing, which probably the company has started focusing and moving ahead clearly with a good vision and growth coming through there. So, so implementing that, probably yes, the strategy remains intact. Yeah.
Got it. And the last question I had for you is that obviously being a slightly smaller company, recruiting will always be slightly challenging, and we're hearing that recruiting issues and headcount issues, with the largest of the IT services companies, So how do we think about that in the scope of, going forward? Is that going to continue to be a pressure? How do we mitigate that? And how should we be thinking about this going on?
Yeah. So I just want you to take a step back basically and look at the older days of 2000 to 2000, probably 2009, 10, 11, whatever it is, if you look through, it is that I think we are all from the old school of thought in terms of probably a different industry altogether. This industry is something like where people are treated like a demigod. And it is all human brain, and then if they don't deliver, we don't deliver. So we fail clearly. So those days, it was the competition has been always basically being a fresher, because the freshers invariably come out of the college, they take offers, and then it's not a story. They always take an offer, go to the pizza corner to see whether they get 1,000 rupees more into another company and start looking at it. So the exodus of the fresher was quite high. Today with this pandemic, the freshers want to come and stay for a long, and companies also give a high startup salary and try to bind them. But I think when these guys, in terms of the mindset, come and they become specialists when they learn things up basically at a mid-level, clearly in the pyramid. At a mid-level, when the exodus happen, and one comes to know as a crossfire, and the fire spreads like anything basically, because this company has got a project on selenium, and there's a full amount of technology need over there, and companies are willing to throw money and take things. So it's not the question of size. It's the question of basically, okay, fine. At 3,000, 3,500 people, for me, I think I'm very decent size. And if you look at my a new employee will come and look at whether this company has got a debt, this company has got a cash reserve, this company has got XYZ. He only looks at basically whether I get today's money, 30% more than what this company is paying me, somebody is willing to pay, let me start doing it. So this is the challenge everywhere which is coming through. And this has hit us this year very clearly with more work from home, because these guys feel that with work from home, I can be anywhere and available for anyone. And why not I take a bit, and tomorrow when it comes back to a physical office to come back, I don't mind quitting a job and coming back to a place where I need to work. So that's a tendency clearly. And we expect that to taper down clearly. And it should happen because more and more clients will not be absorbing these costs invariably. So at some point of time, it's going to be a clear, see, we are now demarcating a line very clearly that if anything less than 25% of the gross margin, do we accept the business or not? No, we're not going to accept any business, and we're not accepting business very clearly. The reason is that a threshold is 25%, and we optimize on the SG&A so that to leave something on the table very clearly, and that too if it's a specialized job, volume job, so where we'll have a scope to increase it to 30% or 35% or whatever it is. So it's a chicken and egg story invariably, and today we are dancing to the tunes of the market as to what is happening around. This is through the early days of 2012 to 15 or something. I strongly feel that the reversal will happen basically once the tailwind business gets cut down, which I'm seeing basically where customers have started moving in for a tighter budgets as they start looking at, and they are looking at a valued company clearly. So I think it will get evened out in 2 quarters. Yeah.
All right, guys. All right. Thank you so much, sir, and all the best.
Yeah, thank you.
Thank you. The next question is from the line of Surbhi Saraugi from SMIPS. Please go ahead.
Hello. Hello. Am I audible?
Yeah, very much, madam. Please go ahead. Good evening.
Yes. Good evening, sir. Sir, I have only one question, and that is the sundry debtors on Cigniti's balance sheet have grown to rupees 232 crore from rupees 157 crore in 9 months financial year 22. So can you just elaborate the reason behind it?
It's a good question, but I think my measure will be very clearly, yeah, that is one of the reasons basically. Also, if you look at the cash flow will look at as free cash flow generation is slightly low. The reason is that it's not a cause for worry for me basically in terms of the number of days where we are hovering around 58, 59 days only, because my revenue has grown by 35% with an enhanced base of revenue which is coming there for me. When I'm pegging the same percentage at about 58 to 59 days, so the DSO marginally increased by 3-4 days. Probably I would say that last year was 58 days and this year is 59 days, about a day which just went up, which is not a cause for concern. But I think considering the high volume of business which has been attributed out very clearly, I think, and considering the pandemic where we are in, where most of the companies have gone ahead with 70 days revisions or whatever it is in terms of the days, I think we are in a very decent wicket and we have controlled the collections. But one has to understand probably if the same amount of growth what I try to do in the next year will work through probably, I don't think this comparison will hold good very clearly. We will be in a very good wicket. But I think on a ball-to-ball comparison, on an eye-to-eye comparison, an apple-to-apple comparison, when you look at it, I have moved from 58 days to 59 days. That is the only difference. But otherwise, my volumes have picked up by 35%.
Okay. Okay, sir. That was quite helpful. Thank you.
Yeah.
Thank you. Ladies and gentlemen, that was the last question for today's conference. I now hand the conference over to Mr. Srikant Chakhilam for closing comments. Over to you, sir.
Thank you, everyone. Thanks for your participation today, and we will certainly take some of the feedback and digest it and get back and huddle up again, and we will see you all in the next earnings call. Thank you.
Thank you. Ladies and gentlemen, on behalf of Cigniti Technologies Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.